Hello everyone, it's Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you the Week in Focus. Well, the FX market has seen a lot of volatility so far this year, and it's likely to see more this week as we have not one, not two, but three major central bank meetings and the monthly U.S. non-farm payrolls. Now, none of the central bank meetings is expected to result in any change in policy, but there could be a change in nuance that affects currencies. Meanwhile, the surge of executive orders and Twitter comments coming out of the White House shows no signs of slowing down. That should also keep the bond market volatile, the U.S. bond market, and the dollar too. Now, the rise in bond yields globally since the U.S. presidential election has reduced the need for the Bank of Japan to increase its stimulus measures. That's because by holding Japanese yields steady, the yield spread against other countries naturally widens and takes some pressure off the yen. So with no change in policy likely this time, the focus at this week's Bank of Japan meeting will therefore be on any hints that Bank of Japan Governor Kuroda gives about the future when he makes his press conference after the meeting. I think he's likely to take a more optimistic view about the Japanese economy, and that could boost the yen somewhat. Now in the US, the FOMC meeting could be somewhat of a non-event for the markets. That's because there hasn't been that much change in the data since the December 13th and 14th meeting, so there shouldn't be much change in the view either. With little change likely in the statement and no press conference afterwards, the meeting might provide little impetus to trading. The Bank of England Monetary Policy Committee meeting, on the other hand, could prove more contentious. On the one hand, the Bank of England's concerned about what Brexit means for the long-term health of the UK economy. On the other hand, Britain probably registered the strongest growth of any of the G7 countries last year, and inflation is trending higher because of the plunge in sterling. But while there may be some dissent at the meeting, I'd expect the MPC as a whole to stress the downside risks from Brexit and maintain their neutral bias. That could prove negative for the pound. Now, after the central bank meetings, the focus will turn to Friday's U.S. non-farm payroll report. Payrolls are expected to continue to rise at around the same pace as they have been recently. The impact of the figure is therefore likely to depend on how much it surprises the market. It usually takes a fairly big surprise nowadays to get a big movement out of euro-dollar. Other important indicators out this week include the German CPI on Monday and EU-wide CPI on Tuesday. Although headline EU inflation is expected to rise, the core inflation measure isn't. Until core inflation starts to rise towards the ECB's 2% target, they're likely to maintain their loose monetary policy, and the euro is likely to weaken, in my view. Also, the final purchasing managers indices are coming out this week, including the figures for Britain and China. The UK PMIs are expected to slow somewhat, which might add to the negative tone that I expect for sterling. China's PMIs are also expected to fall a notch or two. That might, at the margin, weaken the Australian dollar. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.